Well, good morning, ladies and gentlemen. Welcome to the latest in our series of webinars aimed at private client and entrepreneurial business clients. Today's subject is choice of business entity. As usual, you have me to listen to, Patrick King. I'm a tax partner at McIntyre Hudson, and my colleague James Kipping, another tax partner who's head of private client. So between us, we'll go through what we have today. We have quite a large number of slides today, so we may have to hurry, we may have to skip a few, and we may not have that much time at the end for questions. But the plan is to have a little bit of time at the end for questions, and obviously you can fire them in as usual via the chat or the Q&A function rather as we go along, and we'll try and answer if we can as we go along as well. So moving on then. Moving on to our agenda today. So choice of entity, we'll run through some of the options. We'll have a section on the non-corporate options, although I might explain on that slide that that's perhaps not quite what I'm saying. We'll look at the incorporation of existing business, how we get cash out of different sorts of business, principally the corporate option. Tax, more detailed tax implications of incorporating existing business. Other considerations for incorporation, and then what happens at the end, although not in great detail because that's a subject of a whole separate webinar, cessation and succession, but we will look a little bit at some of the implications you have to worry about when coming to the end of your business life, whether it's a sale or retirement or succession or whatever it may be. So looking at choice of entity in a bit more detail. What are the main options? So this slide sets them out. You can be a sole trader, just set up and operate on your own in no particular type of entity. You may want to operate with a group of others, which could therefore be a partnership of individuals. It is possible for several companies to come together and form a partnership where they're trading together. LLP stands for Limited Liability Partnership, which, as the name suggests, is a partnership, but with an element at least of limited liability. It's sort of halfway between a company and a partnership. Again, you can have an LLP with company members. You can potentially have mixed LLPs with individuals and companies. Then we get to the limited company, which is probably the most common form of business structure in the UK, and to be fair, in its different forms around the world. And I've mentioned overseas entity because at some point you may have expanded to the point where you want to go overseas, and then you're looking at how you might do that. So we'll very, very briefly look at that too. So what are the main things you need to think about if you're starting up, or even if you're underway, you've got an entity already or a business already, what do you need to think about before you move on to the next type of entity, or whether when you first set yourself up? One key question is, what is the level of risk in the business you're choosing to undertake? If you think there is a significant risk of things going wrong and you being sued, then limited liability in some form is probably worth considering. And that is why, in essence, an awful lot of businesses just go straight to a limited company setup, because it does give them that limited liability. They're not as easily going to lose their house and everything they've ever worked for if they're operating through a limited liability company. Or indeed, to perhaps a slightly lesser extent, a limited liability partnership. Other things that you have to think about: flexibility. It's much more flexible in a non-corporate setting than in a corporate setting. Well, I say much more flexible. There are greater flexibilities in a non-corporate entity. So depending again what you're trying to do, it may be that you, at least at the start, you want to be unincorporated. And more in a minute. Tax cost, are there benefits to being a company compared to not being a company, or vice versa? And James will have a reasonably long session on that a little later on about some of the possible benefits and costs of going one way or the other. Succession, how do you see this business moving on in due course when you want to bring new people in, how you're expanding? These are all relevant considerations. And ultimately, sale. What is it you want to be selling at the end of the day? Another area that makes a difference as to what sort of business you might choose is whether you are a new or an existing business, and also the type of business that you are. The considerations will be different depending on what it is. So you need to think about, if you have an existing business, for instance, and you're looking to incorporate it, you can't just become a company. Well, that's not strictly true. You can just become a company, but there are consequences of doing that. And we'll talk a bit more about that later. I've mentioned CGT, capital gains tax, and stamp duty land tax there, which are considerations if you're incorporating. If you're a new business, then that doesn't really come into it. You can just become a company and start the business up. There's very little to worry about. But when you're incorporating, you do have to think about a number of areas. It may be different, the type of structure you want, based on whether you're a trading entity or a property business, for instance. If you're a property business, then there may be good reasons not to incorporate, depending on what your plans are. And if you do incorporate, there's a lot more to concern yourself with how you do it. And again, we'll cover a bit more detail on that. How long do you think you're going to be in business? What are your intentions at the end? What are your plans for your capital wealth? These are all factors in deciding what structure you might take. And you have to remember that if you have an existing business and you're moving into a corporate structure, there's going to be more to do than if you're just setting up from scratch. So let's look at non-corporate entities first. Now, I mentioned there sole trades, partnerships, and LLPs. So strictly, LLPs are corporate entities. I've included them in this non-corporate group because for tax purposes, they are treated, in most cases, the same as a normal partnership. So as if they're unincorporated, but they are technically corporates, not particularly relevant for today, but it can be relevant in other areas. There are quite significant commercial variances between the different types of entity, trades, partnerships, and LLPs. But from a tax point of view, and this primarily is a tax webinar after all, from a tax point of view, they're very similar. In essence, profits are going to be taxed and gains are going to be taxed as they arise, whether you're a sole trader, a partnership, or a partner in an LLP. So there's no ability within this sort of structure for having a very good year, for instance, and keeping some of the money back and maybe taking it out in later years. You can keep the money back by all means, but you will be taxed on it in the year you make it. So one reason for thinking about becoming a limited liability is if you have a very lumpy profit profile, for instance, perhaps a development business where you might have £1 million of profit in 1 year and then nothing for a couple of years and then another £1 million after that. As a sole trader or partnership or an LLP, all that million is going to be taxed in the year you get it. If you're a limited company, you could potentially spread the extraction of money from the company over several years and keep your tax at a more reasonable level. But James will talk a bit more about that later on. Partnerships are sometimes seen as quite complicated from a tax point of view, but in essence they're not. In essence they're the same as a sole trader. It's just several people operating together. They're taxed in exactly the same way as a sole trader, but you have to first work out what their share of the profit is. So the technical bit, or the tricky bit if you like, is working out how much profit relates to each person. Other than that though, both partnerships and LLPs are taxed in the same way, more or less, as a sole trader. I mentioned LLPs are corporate, so one of the benefits you get from an LLP structure over a normal partnership is limited liability. So McIntyre Hudson, for instance, my firm is an LLP, and we became an LLP many years ago now, because that does give us limited liability protection. So if you are in a business again, which is risky, you do need the flexibility of operating as a partnership rather than a corporate, then limited liability partnership is certainly worth looking at. It is possible to have mixed partnerships, and for a while it was kind of the holy grail, if you like, of having a partnership of individuals, with the individuals also having corporate under their control, which were also partners. So each person effectively was two within the LLP, and that they were themselves and could have a share of profit, which is very flexibly decided by the partnership, and they were also a limited company which could receive some of their profit share and retain it, and therefore not have to pay tax on it straight away. And when I say not have to pay tax on it straight away, we'll explain more later, but companies don't pay income tax, they pay corporate tax, which is a lower rate, which is why that's potentially beneficial. Unfortunately, or fortunately, as the case may be, the ability to use mixed partnerships to benefit from the flexibility of partnerships and the limited liability and ability to shelter income from income tax of companies was stopped. It was deemed to be avoidance, and that was stopped some time ago now. So you can still have mixed partnerships, but if there is a connection between an individual and a company that's a member, then the profits of the company are likely to be attributed to the member such that they're taxed, even though they're in the company. And that was to stop people getting the best of both worlds in that way. And I think, no, not quite. One more slide to go before I hand over to James. In the early years of a new business, it's fairly common, inevitably, that in your teething troubles at the start, that losses are incurred. In fact, many businesses start intending or planning, expecting to make losses in the first year or two. As a sole trader or a partnership, you have a much greater flexibility of what you can do with those losses than if you're a corporate. So as a sole trader partnership, if you make a loss in the early years of trade, you can carry that loss back against total income from the previous 3 years that you have. So if you have got reasonable income from other businesses, ventures, employments, whatever, leading up to when you start your business, and you make a loss in the early years, you can carry that loss back and get immediate relief for it and get some tax back. If you start as a company, however, the loss can only be carried forward. So you will get relief for it against future profits, but you can't carry it back against your own income from earlier years, which is why it's quite common to start as a sole trader partnership and then ultimately become a company and incorporate later. And the same can be applied to when you first go overseas. You may want to start overseas as a branch, such that if it makes a loss, that loss is still part of your business here and you can claim the relief here. And then when you're successful, turn that branch into an overseas entity in its own right. But that's probably another webinar to go into any detail. And I think at that point, I'm handing over to James to talk a bit more about the incorporation of an existing business.
Thank you, Patrick. Morning, everyone. I'll skip straight onto the first slide and just start really with, the reasons why people might want to incorporate or rather operate through a company, whether that's start off with a company or transfer an existing unincorporated business into a company. There are all sorts of reasons. Many are linked to tax, but that's not always the case. For example, the main non-tax reasons are listed on this slide, and they include limited liability, as Patrick has said, although this can obviously be achieved also with an LLP partnership structure as well, so it's not absolutely necessary to use a company to get limited liability protection. Prestige, often a company might give the perception that the organisation is larger and more established than it actually is. Familiarity, I find that people who have been in business throughout their life understand companies, and therefore when setting up a new business, prefer a corporate structure. Trade preference it can be a key one. Your customers expect you to be operating as a limited company, and in some cases require you to be so. Borrowing and leasing, fragmenting ownership, perhaps it's easier to sell a business as a company. They're all considerations to be taken into account that aren't necessarily tax considerations. The reasons listed here are linked in some way to tax mitigation, and we'll discuss them in more throughout the session. But just to summarise, flexibility over income in respect of timing and form of remuneration. So that's really the ability for one to retain profits within a corporate structure at lower corporation tax rates, as I'll come to explain, and only pay extraction taxes when you need to draw that income personally. Thirdly on this slide, a greater ease of attracting investment, perhaps due to tax incentives offered for investments into corporate entities that aren't available for unincorporated entities. And again, I'll come on to the types of investment and the tax incentives offered for those types of investments. And there's certain forms of tax relief that are only available to companies. The most obvious one and most well known is the research and development tax credit. You have to be operating as a limited company to take advantage of that relief. So this slide lists the various taxes that need to be considered. So when you come to us and say, well, should I operate through a company or not? Should I transfer my existing business to a company or not? We will need to think about all these taxes, some in a greater way than others, and often depending upon the type of business and its assets and your particular circumstances. Usually, the first consideration, though, will be that as a sole trader, the proprietor pays income tax and national insurance on the profits as they arise. Whereas if you're operating as a company, the business pays corporation tax on its profits, and then the business owners pay income tax on their remuneration and or dividends. So usually the first question that arises is, which provides the best effective tax rate for the particular circumstances? So I'll look at that in more detail next, but from the outset we must bear in mind that there are numerous other tax considerations that may either encourage or discourage particular businesses from incorporating. So as I say, those different taxes are listed here, and we'll discuss them further in due course. As I say then, moving on to the next section, the first consideration is usually in relation to cash extraction. So let's look at that in more detail first. And I'll reiterate here that as an unincorporated business, so a sole trader, a partnership, or even an LLP, profits are normally taxed as they arise on the partners or members or sole proprietors, and that's subject to income tax and class 2 and 4 national insurance. There's no employer's NIC on your profit share as a partner or a sole trader. Of course, if the business employs people, then employer's NIC is payable on your staff's salaries. The final 2 points here on this slide: partnerships and LLPs offer greater flexibility in terms of profit sharing, which can be difficult to replicate in a corporate environment. And as Patrick explained, actually, it became common for there to be a partnership with corporate members so that people could enjoy the flexibility of a partnership structure, as well as perhaps the tax efficiency of a corporate entity, because profits would be assessed to corporation tax as they are allocated to the corporate partner. But now that's subject to considerable anti-avoidance, so we won't consider it in any significant detail in this talk. For companies, profits are subject to corporation tax. The current rate of corporation tax is 19%, and we know it's due to increase to 25% from 2023. But there are many ways, or many options rather, of extracting profits as remuneration, depending, of course, on circumstances. So not all of these listed here are available to everyone. Firstly, though, a company offers control over the timing of extraction. So cliff edges and high effective tax rates can sometimes be avoided, i.e. it becomes more, easier to manage the level of your personal income as an owner-manager with a company than with an unincorporated entity. As I say, the various other forms of remuneration, so cash and bonus, salary essentially, benefits in kind, dividends, loan interest, perhaps if you've advanced money to the corporate entity, rental income if the company is using a property that you own personally, pension contributions, i.e. employer pension contributions, in limited circumstances making loans to the owner-manager is an option, although that's itself subject to anti-avoidance. However, despite all these forms of remuneration or profit extraction listed here, usually it's a combination of the above which becomes most tax efficient, with the owner-manager's personal circumstances and level of profitability dictating the precise strategy. In simple cases, though, you will hear accountants say that the most obvious strategy is to take a small salary within the NIC limits and the balance as dividend income. And that's a rule of thumb, really, unless in exceptional circumstances or if there's something specific that needs to be taken into account. So one exceptional circumstance might be where a company is undertaking R&Ds, that's research and development and qualifying work, and therefore paying a salary rather than a dividend to the owner-manager for his involvement in the R&D work can enhance the qualifying research and development costs and therefore the size of the R&D tax credits. That's just a little example of where there might be an exception. Nevertheless, the rule of thumb is that the bulk of remuneration should usually be taken as a dividend. So let's look at some comparisons, and I will simply compare dividend income from a company with profit being taxed as it arises in the situation of a sole proprietor or a partner of a partnership or member of an LLP. I should firstly say that there's 4 or 5 slides here full of numbers, and it's going to be difficult for me to really draw out or rather explain the numbers in any detail. I'll try and draw out the key points. So on the first slide here, we look at the effective tax rate in the current tax year for a sole trader or partner of a partnership with income at 50,000, 100,000 and 150,000. So you will see the effective tax rates, ER, on the slide there at the very bottom. Okay, and you'll see that for £50,000 of profit, the effective tax rate is 22.39%, going up to 39.56% for someone with a profit of 150,000 as a sole trader or partner. Moving on to the second slide, we look at the same levels of profitability in a company with all the profit being extracted as a dividend. So this assumes that we're wanting to extract everything that the company makes, or all the profit that the company makes. Now, as I say, I appreciate it's difficult to compare across the separate slides here, but you will see that the effective rate is slightly lower in the company where profits are above 50,000. So if someone comes to me and says, when does it become cheaper from a tax perspective to operate through a company? We might say, look, it's marginally cheaper if you're making profits in excess of £50,000, and of course you want to, and you still want to extract all the profit. There's just a percentage point or two difference, though. So it's marginal, although that marginal benefit can be enhanced a little further by taking the first slice of profit as a salary. So that's back to that rule of thumb. But it also tells me probably that the difference is too small to force an incorporation where there's a full extraction policy. So where a business wants to extract all its profit, or a business owner wants to extract all the profit. Therefore, there probably needs to be a desire to retain profits in the company to reinvest in the business, or some other reason to incorporate, in my view. The next 4 slides, sorry for confusing you with the numbers here, look at the forthcoming tax years with known changes to tax regimes. So we know that sole traders and partners are going to suffer the higher NIC rates, which will then become a social care levy and add 1.25% to the effective tax rates. That's effectively an increase to national insurance from 2022, or April 2022. And as shown on the slide that comes next, this also applies to dividends. So broadly speaking, the effective tax rate for both incorporated and unincorporated entities will go up by 1.25% next year. And the conclusion is that for the tax year 2022-23 is essentially the same as before. A company provides a marginally cheaper effective tax rate, but if you're looking to retain profits in a company, potentially that's the higher NIC rate is a reason to incorporate. However, we then look forward to 2023-24, and the effective rate for dividend income from a company becomes higher when corporation tax increases to 25%, at which time it will become less effective where there's a full extraction policy to operate as a company. Okay, so again, probably something to revisit based on particular circumstances, but hopefully I've got across the key message there in terms of profit extraction. On to the next slide. This is the final slide full of numbers, you'll be pleased to hear. And of course, I've probably completely lost you, but this final slide shows that the effective tax rate is much lower if profits can be extracted from a company by charging a rent on premises owned by the business owner personally, and obviously used by the company, or perhaps an interest on loans advanced to the company. This isn't available to everyone, but where it is available, you can see that the effective tax rates are much lower. Now, this method of extraction became less common over recent years as corporate tax rates have been very low, but the higher corporation tax rate and the fact that such income does not attract the social care levy, or won't attract the social care levy or higher NIC rate, will probably make it more prevalent again. Therefore, arguably for us tax advisors, extraction strategies are probably about to become more interesting again. Excuse me. So this slide just summarizes what I've just said. So in order to avoid simply repeating myself, I'll just mention or draw out the key point, I think, here, that where there is a salary or pension contribution paid by the company, it must be set at a level that is commensurate to the duties performed by the individual in order to secure a corporation tax deduction. So that's the second to last point there, that, you know, salary or pension contribution and remuneration must be at a market value to secure that corporation tax deduction. In an extreme example, the managing director or shareholder should not say employ his or her spouse as a part-time admin clerk, say, pay them a six-figure salary and 40k a year pension contribution, and expect HMRC to allow a corporation tax deduction for those costs. Those costs are far more than would be paid to someone on an arm's length basis. However, if that person is also a director, HMRC's argument becomes much more difficult to run, because a director has certain fiduciary duties and responsibilities for running the company. So I suppose this just highlights the importance of taking advice and not simply looking at the tax rates and drawing your own conclusions. And of course, the advice is important not only to maximise opportunities, but minimise the risk of any sort of challenge from HMRC. And this principle, and I'm going to skip over this slide in the interest of time, but this principle that I've just raised was highlighted in the case of William McAdam, which is summarised on the next slide. And there was essentially a tax inquiry into a plumber in respect of perceived understated takings in relation to wife's wages between 2009, 10 and 11 and 13, 14. In this situation, the plumber paid his spouse £90 a week, or just under £5,000 a year, for answering the phone, banking, admin tasks. HMRC said, well, is this wholly and exclusively for the business? Is this an excessive payment? Even of numbers as small as this, under £5,000, normally, even I would have said, oh, this would surely not raise HMRC's eyebrows in any way. HMRC, however, argued that only 3 hours a week at £8 an hour was commensurate to the duties, and restricted the deduction to £1,344. So this just shows that even in the smallest of cases, the rule should not be abused in any way, and particular care needs to be taken over salaried remuneration and similar remuneration. And as I say, the final point there, if the spouse was a director in the company or a partner in a partnership, then I don't think this problem would have arisen in this particular case. And I think this is my final slide before handing it back over to Patrick, and it just looks at family situations and highlights that there's often a temptation to involve family members at shareholder level in a corporate entity to spread income around the family and effectively minimise the overall income tax burden. Now, this can work if it's done properly, but only to a certain extent. So again, it highlights the importance of taking advice in this area. Firstly, though, it does not work where there are minor children. So income that you try and allocate to your own minor children by perhaps giving them a shareholding and paying a dividend will always remain taxable on the parents. Let's consider, though, a company where both spouses are the shareholders, so husband and wife are shareholders, and all shares have the same rights to income and capital, so full rights to income and capital. Where dividends are paid on those shares in proportion to the shareholdings, there shouldn't be a problem, even if that spreads income between spouses where one spouse is doing most of the work for the company. So there is an opportunity here that HMRC did try and attack many years ago on the old Arctic Systems case, but failed. And essentially nothing has changed since. However, problems arise under what is known as the settlement legislation, where there is an attempt to divert a greater proportion of income to spouses, for example, by paying higher dividends on shares owned by one spouse, or by one spouse waiving an entitlement to enhance the dividend paid to the other. In that case, HMRC will treat the enhanced element of the dividend as remain taxed on the spouse who is trying to give it up. And I suppose I should mention as a final point before I hand over to Patrick, that it's not just spouses that are affected by this. It can apply to any bounteous arrangement. So I'll hand back over to Patrick. Thank you.
Thanks, James. So I mentioned in my first bit that there were tax complications or tax implications of incorporating an existing business. And so in this section, we're just going to give a little bit more detail on what I mean by that. And I think probably the single key thing to remember when looking at this, bearing in mind you're thinking, I have a partnership or I have a sole trade, I just want to make it into a company, why can't I just do that? And there's people like me saying there are tax consequences. Well, the reason there are tax consequences is, and say this is the important thing to remember, a limited company is not you. A limited company is a separate person for legal purposes. So once you set up a company, that is another person. And if you transfer your existing business to that company, you are transferring your business to somebody else. Now, you own somebody else, but it's not you. And I think that is the reason, or that is the explanation as to why there are tax consequences. So if we look firstly at VAT. Now, I mentioned VAT first because VAT is something that is easily forgotten, but is very relevant and can be very important in this sort of transaction. As I say, you're moving your business to somebody else. So you're making a disposal, a supply of the assets, etc. of your business, be it stock, be that fixed assets and so on. You're moving it to somebody else. And that is in essence a taxable supply for VAT purposes. And so without a relief, there would be a large VAT bill on that transfer, which of course the company could then recover. But from a cash flow point of view, you don't want to do that, normally anyway. Fortunately, there is a relief called transfer of going concern, which means that it will be treated as effectively as treated as not a taxable supply, and it will go across as it stands with no VAT payable and reclaimable. But you do have to meet certain conditions in order to qualify for that, and they're shown on the slide there. Basically, the whole business has to go, or at least a defined area of business. It has to be operated in the same way with no significant break. And if you have interests in land of any sort, then it's essential that you take advice, because anything to do with land and VAT always becomes complicated, or nearly always becomes complicated. So TOGC, as we call it, is the answer to the VAT problem. But you do need to follow certain rules in order to make sure it works correctly and get advice, particularly if there's property involved. If we move on to capital gains tax, as I've said, you are disposing of your business to somebody else. Where you dispose of any asset to somebody else, including family members, but in this case to a company, you are treated for tax purposes as selling it at market value at that point in time. So obviously, assuming you've been successful so far, the value of the business will have gone up from when you first started it, whether you bought it or established it yourself. And therefore there's likely to be a gain. And if there's a gain, there's capital gains tax. So in essence, when you transfer your business to the other person, being the company, you're selling it at market value as far as tax is concerned, and there will be a tax bill. Again, there are reliefs that allow you to get around this, and there's two particular ones. They're mentioned there on the slide, Section 165 and Section 162. Now, I'll deal with them the other way around, the way they're on the slide, because that makes more sense to me, but either works. The most straightforward way, and the way often used, is the Section 162 relief, which is the incorporation relief, usually, whereby so long as you transfer the whole of your business to the company in one go, so you're not allowed to leave anything behind. You take everything across. The only thing you can leave out of that is cash. Everything else has to go. Then the company will be treated as acquiring it at current market value, and the gain is rolled over into the value of the shares that you take. So the company issues shares to you in exchange for your business. Those shares, for tax purposes, their base cost for any future disposal is your original cost of your original business. That is where the gain has gone. So the company has the assets at the current value, which means day one, day two after the company's in existence and has all the assets, it could sell assets with no gain because it's worth what it is on that day. Obviously, the gain increases going forward, but at that point in time, it's taking it on at the current value. All the gain is in your shares. So when you sell the shares, that is when the tax will become payable. If you want to keep certain assets out of the business that you're transferring to the company, then it may be you have to look at the Section 165 route instead, which operates in a different way. This is as it says on the slide, gift of business assets. Here you transfer the assets to the company and you claim Section 165 relief on that particular transfer. So, for instance, if you transferred a property to the company with a large gain in it, the company would take that property not at the current market value as under the Section 162 route, but at your original base cost. And then any gain would be taxed on the company when and if it disposed of it. So that is the difference. But the real advantage of the 165 over 162, where you don't want to put everything across into the company, is you can pick and choose what you transfer. You can also transfer things at an undervalue, so you can accept a certain amount of money, which you can then keep as a loan account owed to you by the company. So say you sell the property to the company for half its full value, the gain part, the excess is held over, but the half value is an amount that the company owes you, which you can then pay out to you as and when it gets money in the future with no further tax. So that's a possible way forward. Which I think is probably moving into this slide actually. It is possible to sell your business to the company and not claim any of these reliefs, or partly claim them, as I was just explaining, under the 165 route, whereby the company agrees to pay you some money. The company at day one has no cash, of course, so it'll be a loan. It owes you that money, but you can take that money out as and when the company makes profit. And because it's owed to you, there is no more tax on it, so that can be quite efficient. And if you're thinking of planning for capital tax purposes, which we've talked about in previous webinars, it may be that you choose to give away some of that loan after incorporation to family members, say, treat that as a potentially exempt transfer. Goodwill, when you've got a successful business, it's quite possible that there'll be a lot of value in the goodwill. Now, goodwill is an intangible asset. It's not a physical thing. It's not a machine. It's not a property. It's what the business is worth because of how profitably you made it. We used to quite commonly put a large value on goodwill, transfer it across, possibly as a sale, either at undervalue or full value, pay some capital gains tax on it, possibly claiming a low tax rate because it's a business asset, and therefore we can claim what's now called business assets disposal relief, which we've talked about before, and get a 10% tax rate, and then take the money out from the loan in the future tax-free. And that was a very efficient way of extracting money going forward. Those rules were stopped. That was stopped some years ago now, such that goodwill now no longer qualifies for business asset disposal relief, so it will be taxed at the full capital gains tax rate of 20% if you do sell it. And you used to also be able to claim a deduction from your profits going forward, amortization of the goodwill, which again is no longer allowed. So the incentive to put forward a large value for goodwill on an incorporation has largely gone, although in some circumstances it can still be worth looking at. You do have to bear in mind, though, that the revenue are quite keen on looking at goodwill. Not all types of goodwill can be transferred. Some of it's personal and belongs to the individual and can't be transferred across. So goodwill we need to look at, but it may not be the best choice. And also, if you did put a high value of goodwill, and we've seen this, you put a high value on goodwill, the revenue decide they're going to fight it and say that's not capital, they're going to treat it as income because you've paid too much for it, for instance, then what you expected to be a gain taxed at 20%, or in the old days maybe even 10%, suddenly becomes income taxed at up to 45%. So it's worth being careful over what you put through for goodwill. Inheritance tax is unlikely to be a problem on incorporation. Generally speaking, a business will qualify for inheritance tax reliefs, business property relief, etc., and the company should as well. So if you transfer everything into the company, we don't normally expect that to give rise to any inheritance tax problem going forward. Stamp duty land tax is always worth considering. If you have any property involved in your business, which you're moving across, so if, for instance, it is a property business, then stamp duty land tax is chargeable. There's no special relief on an incorporation, unlike for capital gains and VAT. So this can become quite a significant problem. If you are looking at incorporating a property business, we can sometimes mitigate or avoid the stamp duty land tax if we can structure you via a partnership on the way in. But that's a whole separate piece of advice. It may be possible to reduce it, but in essence, if there's property being involved in your incorporation, then stamp duty land tax is going to be payable. Corporation tax, as James has already said, companies pay corporation tax and not income tax. Currently that's 19%, but it's changing 1st of April 2023 to 25%. So one of the reasons to consider having a corporate environment other than limited liability is that profits that you don't need to take out now or you want to retain to help grow the business are only taxed at corporate rates, say 19% going up to 25%, rather than in your partnership or sole trade circumstance, where whatever you do, they're going to be taxed at a full income tax rate of maybe 40 or 45%. So that's a real incentive when you're retaining profits within the company for whatever reason to use, within the business for any reason, to use a corporate environment. I've mentioned that there is a small company rate coming in new rules, and some of you will remember the days of small companies relief in the past. I'm not going to spend any time on this because we don't have much, but in essence, if you have profits of less than £50,000 in a trading company, then your tax rate will remain at 19%. Between £50,000 and £250,000 of profit, it slowly grows up to the 25% rate, and there's a marginal rate in that band of 26.5%. So it's not huge like it used to be, but it's just for very small companies, it's worth thinking about. And I will just mention quickly at the end, we've mentioned family investment companies in the past and had seminars or webinars dealing with those. I don't think this changes the benefits or potential benefits of such structures, but it's worth bearing in mind that from April 2023, close investment holding companies, which would include most family investment companies, so it's a company controlled by 5 or fewer people, that's an investment company in essence, will be subject to the higher rate of corporation tax. They don't benefit from that small company rate of 19% on the first 50. They will be taxed at the higher rate. So that is an increase in tax for that sort of company. And I think at that point, I'm handing you back to James again.
Thank you, Patrick. So other considerations on incorporation of an existing business. So pick out the key points here in the interest of time. But timing is important. And this slide highlights some technical points that we would consider when advising on when to incorporate. Incorporation is treated as a cessation of trade, but specific rules apply to allow the transfer of things such as capital allowances, pools, and the ability to use brought forward losses so that most potential problems can be avoided. A business might consider incorporating because it expects profitability to increase. So the corporate structure might allow profits to be retained more effectively. Where an unincorporated business has an accounting date that does not align with the tax year end, there may be what we call overlap profits. These are profits that were taxed twice in the opening years of the unincorporated trade, and these can be deducted from profits in the final period, i.e. the period that the business is transferred to a company. So this might influence the decision on whether to incorporate and when to incorporate. And I won't go into the calculations, but the final point there says that it's often best to incorporate early in a tax year. And I mentioned in the first part of my talk that some tax reliefs are only available to companies, and that really forces the hand of businesses into operating through a company. The key ones that we see really are companies that undertake research and development, or which qualify for the patent box regime. That's the 10% corporation tax rate on profits from patents and IP, etc. Creative in the creative industries, the reliefs available to businesses in that area typically are only available through limited companies. And the final point on this slide here is very, very relevant for businesses that need or are seeking investments, or are early stage companies seeking investment, in that certain venture capital reliefs are only available for investors into corporate entities. Where are we? Before I go on to the venture capital reliefs, actually, I'm just going to talk about flexibility, because this is probably one of the biggest considerations. Partnerships offer least flexibility in terms of timing of profits, but greatest flexibility in terms of altering the profit sharing ratio and admission and retirement of partners without significant tax problems. That's why most professional practices still operate as partnerships or LLPs. Companies allow the accumulation of profits until required, so provide an opportunity to manipulate and regulate personal income and maximise the tax efficiency. However, on the flip side, they are less flexible generally in terms of share capital, and generally it's more difficult to bring people, or rather employees, into the share ownership structure without tax charges. But moving back to the issue of external investment and venture and capital schemes, this can be a big consideration for early stage companies, and it can force it can force early stage businesses into operating as a company. The main reliefs from a tax perspective are the enterprise investment scheme and the seed enterprise investment scheme. Both offer tax reliefs as incentives to the investors to invest in that particular company. I'm not going to run through the conditions for the enterprise investment scheme, other than to say the company or the business needs to be undertaking a qualifying trade. And essentially there are excluded trades such as trades involving land and property, financial services, which are kind of deemed to be less risky. But what reliefs are available? The individual investor receives or can receive 30% income tax relief on the value of their investment. So if they invest £100,000, their income tax bill is reduced by £30,000, but they must otherwise have sufficient tax liability to cover the relief. It can be claimed in the year of subscription or the prior year, so that provides some flexibility for the investor. Other capital gains can be deferred into an EIS investment. So if someone makes a £100,000 capital gain, that would otherwise incur a CGT liability of £20,000, but they can defer that liability by investing the £100,000 gain into EIS or a part thereof. The CGT liability comes into charge when they ultimately dispose of their EIS shares, although it can be rolled into further investment at that time. The sale of EIS shares themselves is CGT exempt for the investor, provided the 3-year holding period is met and the company continues to qualify for relief during that period. Income tax relief must also be claimed on the initial investment. So occasionally we come across situations where someone has no taxable income and makes an EIS investment. They must have income tax relief available to them to get the CGT exemption on an ultimate disposal. If, as does happen on occasion, EIS shares are sold at a loss, then income tax relief is available for that loss. So loss can be set against other income, but the amount of loss relief available is restricted by the relief already provided on the investment itself. Just a final point: someone can invest up to £1 million per annum into EIS, or £2 million if investing in so-called knowledge-intensive companies, KICs, as on the slide there. The seed enterprise investment scheme is similar to EIS, but available to even smaller companies with lower limits and therefore presumably increased risk. The tax incentives are generally higher, so the income tax relief is given at 50% on the initial investment, but there's a 100k per annum limit on the amount that one can invest in SEIS shares. The CGT relief is slightly different in that it provides for a 50% exemption to capital gains rolled into SEIS investments. So if in the example given previously, the individual makes a £100,000 gain, if he or she invests the £100,000 into SEIS, £50,000 of that gain becomes completely exempt and is never brought into charge. Also, thinking about share capital of a company, although I mentioned earlier that generally bringing people into companies at shareholder level presents more complexities than admitting a new partner, for example, there are several approved share schemes that can be really attractive in companies. The most widely used, and the one I'm going to pick up on here, is the EMI scheme. That's the Enterprise Management Incentive Scheme, which we often see as an exit-only scheme, so that it only provides key employees with a share of sale proceeds, in other words, a share of equity, in a tax-efficient manner, without giving them an equity stake in the business until that exit event comes about. So that can be important for businesses that don't necessarily want their key staff to participate at equity level until an exit event. And the final couple of points: it wouldn't be a private client webinar without mentioning inheritance tax. And I know Patrick covered some of this in his earlier slides, so I'd just like to confirm that when business property relief, or I'd just like to confirm when business property relief applies to business interests. So it applies at 100% to shares in unquoted companies and indeed other unincorporated businesses. So in that regard, the decision whether or not to incorporate is often or usually inheritance tax neutral. However, fourth point on the slide here, assets outside of the partnership or the company and which are used in the business only attract 50% business property relief. So 50% of their value is exposed to inheritance tax. This might be a consideration, for example, if you want to incorporate but don't want to transfer the partnership property into the company. You might be reducing the relief available from 100% if it's a partnership asset to 50% if it continues to be used by the business but not part of the company. I'm going to skip over the final point in the interest of time. We've only got a few minutes left. In terms of business property relief problem areas, it says on the slide here IHT and companies, but they're broadly the same for unincorporated and incorporated businesses. In that, one, if there's a binding contract for sale, then business property relief is not available. So care needs to be taken here when drafting partnership agreements in the case of a partnership, obviously, and shareholders agreements in the case of companies, to ensure that upon the death of a partner or shareholder, the provisions do not require the purchase of the deceased's interests, which of course would be a binding contract for sale. There are ways of getting around that and effectively come up with the same thing. In the case of a gift of a business property relief asset, the donee, so the recipient, must continue to own the asset for 7 years after the gift for BPR to be available if the donor does not survive that 7-year period. And that's the case whether you're gifting a partnership interest or shares in a company. And final point before I hand over to Patrick to finish is if the reason to incorporate is to accumulate cash and just suffer corporation tax, then you must be aware of the accepted asset rules, and that's a rule that will usually apply to cash that's accumulated and not used in the business. That element, or rather the element of value attributable to that cash or accepted asset, will not benefit from business property relief. And on that note, I'm going to hand over to Patrick to finish. Sorry, Patrick, I've just clicked this button.
So I forgot to unmute myself. Thanks, James. Yes, I think if you're going to keep control of the screens, then James, that'll be fine. So I want to be very quick here because we have basically run out of time. We would like to deal with a couple of questions right at the end. So you are at the point where you are looking to dispose of your business. And so what are your options? You can obviously sell it. You can sell the company to someone and you'll pay tax on that capital gain. And I'll talk about business asset disposal relief in a moment. Just very briefly on disincorporation. We've talked about incorporation earlier and how relatively easy, although there are some complications to it, but it's relatively easy to do it with minimum tax consequences. You might think the same is true if you decided you want to operate outside the corporate environment. Unfortunately, it isn't. There is no disincorporation relief. There was a very brief dally into some form of disincorporation relief a few years ago, but it didn't really work and it's no longer there. So I think in essence, one of your decision points when incorporating is remember that it's a one-way bet. Once you're in the company, you stay in the company largely until you ultimately sell the company. You can take things out, but there are tax consequences, and that's what I'm trying to get across there. If we go on to the next one, James. If you can't sell your business for some reason, there is no buyer, you don't want to sell it, for whatever reason, then you can potentially wind it up. You can have the company, put the company into liquidation, close it all down, sell everything off, and then take the money out. If you have it formally liquidated, it'll cost you £5,000, £6,000, £7,000 probably to do it, but it means that the company will be closed down officially. There's in reality no comeback to you, the company's gone, and the money you take out will normally be treated as a capital disposal to you, as in capital gains tax will apply and any tax release will apply on the basis of capital gain. There is anti-avoidance provisions here, though, such that if you want to carry on the business in some form within 2 years of winding it up, then that distribution to you, instead of being treated as capital, can be treated as income and taxed at income tax rates. So that's just something to be aware of. You can't close down and start up again. Phoenixing, it was called, and these rules are designed to stop it. But you certainly can close your company down, take the money out and treat it as capital. And that can include a built-up supply of cash, as James was mentioning. So for capital gains tax purposes, you'll probably still be able to get that out as a capital gains tax event rather than as income. If we go on to the next slide, I'm going to skip that one actually because I don't think we really have time for that. If we can go to the next one, business asset disposal relief. I alluded to this earlier on, but just a bit of detail. When you dispose of a business, or all of a business, or part of a business, or the shares in a trading company, then you can qualify for this relief. It used to be called entrepreneurs relief. Now it's BADR, and it gets you a 10% tax rate. If we go to the next slide. These are the main qualifying periods. You have to have owned the business or the share of the company, as the case may be, for more than 2 years. If it's a company, you have to be an employee or an officer, that's a director or a secretary of it. You've only got £1 million lifetime allowance for this, so you have to have not already used that on previous disposals. You need to hold at least 5% of the ordinary share capital and have 5% of the votes, and be entitled to 5% of the assets on a winding up. If you tick all those rules, then you can qualify for a 10% tax rate on up to £1 million worth of gain. So worth having and becoming more valuable if capital gains tax rates go up, of course. You can also claim relief in some circumstances where you have an asset outside the business which you sell after or as part of a disposal from the business. So you sell your business and then you sell the property perhaps at the same, very similar time or shortly thereafter. That can also qualify for BADR as an associated disposal. If you're charging rent for the use of a property in a business, then that may reduce the amount of business asset disposal relief you get. We've said it's no longer as important as it was simply because the amount of the relief is limited to that £1 million now. Prior to a couple of years ago, it was a £10 million limit, so it's much more valuable. Now, there's usually enough value in the business other than the property to use up your £1 million anyway. Sale, if we move on to the next slide, sale I've already mentioned, that's probably straightforward. Companies are commonly sold. If you can get a buyer, you sell it, you can claim your BADR and get the low tax rate. Just one thing again, as James mentioned with private client webinars, we have to mention inheritance tax. A company is a trading company is a business that's going to qualify for business property relief, as James mentioned. Once you've sold it, of course, you have cash, and cash doesn't qualify. So you do have to bear in mind you've turned something from a qualifying exempt asset into something that is taxable for inheritance tax purposes, and plan accordingly. At that point, I think we are out of time, or virtually out of time. We have a minute or two for some questions. So if there are any, we'll see if we can deal with them now, please.
Thank you, Patrick. We do have quite a number of questions, actually, so many of them we'll have to answer otherwise. There are some recurring themes, though. One of those is it possible to operate parallel businesses? In other words, similar, but obviously not the same businesses in a partnership or LLP and a company, and what are the advantages of doing so?
Simple answer, I suppose, Patrick, is yes.
Yes, I was going to say yes. It's an interesting question, isn't it?
I mean, you probably look at each business independently and assess what structure is best. Just trying to think that there's perhaps sometimes some VAT reasons why you might want to segregate businesses, perhaps to avoid partial exemption problems, but that might be getting a bit too technical for a very quick answer. But very quick answer, I suppose, is yes, and you need to look at the businesses independently.
I think that's right. You can do it. If you're doing it because you have some cunning avoidance plan, then be wary. But we could certainly look at that. It's not that uncommon, actually, to have things going parallel and doing slightly different things, but you do need to be a little bit careful.
Another one concerns residents. So is there an advantage, I suppose the question is, to being a non-resident shareholder rather than a non-resident partner? Bearing in mind there's no withholding tax on dividends, which is better.
As a non-resident, yeah, it's right. As a non-resident shareholder, your dividend income would be essentially not taxed in the UK. It's what we call disregarded income. So the tax liability is limited to the tax that's withheld, and there's no tax withheld, so it's tax-free. As a partner, it's transparent, so it comes down to, Patrick, you might need to jump in here, but if you're non-resident, then your profit share shouldn't necessarily be taxed in the UK. But what about if there's a permanent establishment here? So,
well, yes, I think if you've got a business here and permanent establishment here, you would presumably be taxed on that because it's in the UK.
Yeah, so I think on that basis, if you're comparing sort of established UK partnership with company, if you're non-resident and you prefer to be a shareholder, I think if you're a sole trader, you know, if you're clearly non-resident but still performing services, or rather working for UK clients, as long as you don't create a permanent establishment in the UK, then I don't think there's a significant difference.
Right, thank you. There is another one which I think the answer is probably going to be fairly short. I think you probably already answered it, but if you close a company which qualifies for BADR, but then create another company with 2 years for consultancy work, do you have a problem?
So is the new company doing the same business, or is it doing something else?
I think that's what the question alludes to, yes.
Yeah, and I think we'd have to look at it very carefully on the facts, but in essence, if you close a company down and wind it up and take the money out as a capital distribution, and then start doing something else that is similar or the same, you have to be careful whether it's close enough in what it is, then you're at risk of being caught by that anti-phoenixing legislation and the distribution being treated as income. We are fairly comfortable that if you were to sell a business and then become an employee in a business that you didn't own, doing something that was very similar, but you didn't own it, then we think that's okay. But if you own the other business in whole or part, we think that gets called, if that helps.
Thank you. Yes, there's one thing we did miss here, which has been asked a couple of times actually. Can you pay interest on a director's loan account?
Yes, you can. You should be paying interest at a commercial rate, whatever that might be. Otherwise, you run the risk of the interest charge not being deductible for corporation tax purposes. The company would need to withhold basic rate tax on the interest paid to the business owner usually, or director. So that's a bit of additional admin. But as I explained in one of my slides full of numbers, with the increased rate of corporation tax and the higher NIC rate stroke social care levy, paying interest on loan accounts where one exists perhaps becomes more attractive again. You know, it kind of went away as a big thing when corporation tax rates went so low, but I think it will probably become more prevalent again going forward.
Yes, it's probably one of the most attractive ways of getting money out now. That and rent, isn't it, if you have the option?
Yeah.
Thank you, Patrick. One for you. If you're in a property, a limited company with an unconnected shareholder, I think it's meant to be, and you wish to split the property without selling them, is there a simple way to do this?
So is that a property in a company, do you say?
Yeah, so in other words, I think the question is we wish to reverse incorporate. I think that's pretty well what it is, including land.
So take property out of a company?
Yes.
I think the simple answer is that there isn't an easy way of doing it. It's you're looking at disincorporation, aren't you? So there will be a disposal from the company of the property that comes out at market value, with a corporation tax charge if there's a gain in the company, and the individual receiving it will be treated presumably as receiving a distribution, taxable as income, unless I'm missing something there. James, have you got any other thoughts on that?
No, I think that's right. It's really difficult actually to disincorporate tax efficiently. So you're left with either an income distribution to the value of the land or property distributed, or if you can essentially wind the company up as a liquidation, you might obviously pay capital gains tax, as you explained at the end
Yes, it goes to that slide I very quickly skipped through, that once you've incorporated, then you have to pretty much regard yourself as being in that environment. It's not easy to come out of it, certainly without tax consequences.
Thank you. I have another one which there might be a word of caution about. Are there any tax benefits from moving your personal home into a limited company?
Benefits?
Rule of thumb, I'm just going to jump in, Patrick. Rule of thumb would be don't do it.
Yeah, yes, that's what I was going to say. Yes.
Yeah. All number of tax implications, most of them problems.
Yes.
Can't think of any particular benefits, particularly if you're obviously going to continue using it as your main home.
I think there are probably some ultra high net worth individuals that operate with homes in the UK in companies and pay all sorts of extra tax charges as a result. And I think they do that because it gives them other advantages. They're usually non-resident people, for instance. It might give them some other benefits, but for virtually everyone, having a residence of your own in a company is not going to give you a good result.
Yeah, I mean, assuming our audience here are UK res, typically business owner clients, then yeah, that's exactly the answer.
Yeah.
Thank you. I have lots of questions about your predictions for the budget statement later this month, but putting those aside, the last one, which I'll mention, has come up several times, which concerns the administration costs of operating companies. There seems to be a perception that they're particularly high or higher than partnerships. So perhaps you'd let us know if that's the case.
Difficult to say. I mean, as a general rule, there is more administration involved with a company. Filing accounts at company's house, for example, the accounts are more formal and more involved than a straightforward partnership. A company might not necessarily be more costly than a limited liability partnership, because most of the additional requirements that apply for companies also apply for limited liability partnerships, in my understanding. Don't know if you'd say anything else, Patrick, really?
No, I think I tend to agree. I think it probably, on balance, running a business through a company rather than as a sole trader, there's probably some extra admin costs. There's a few more hoops you have to hop through when running as a company, because as I was saying, your company is a different person to you. So when you want anything out of it, you have to go through certain steps. Whereas if it's your own business, you can just do what you like. So there is a bit more admin, so it does tend to cost more, but I wouldn't say it costs spectacularly more. There's just likely a little bit more. And in terms of budget predictions and so on, I don't think we've made a number of predictions in previous webinars or made suggestions as to why people carry out capital planning, because we think there may be changes. We'll have to wait and see at this stage. I think things have changed a little bit. Our next webinar, which I think is on the 4th of November, after the budget, is based on the budget, obviously. So we'll be telling you everything we think is relevant to this group then. So please come along and hear what did happen. Unless you've got any predictions there, James, I think probably we'd leave it there.
Yeah, my only thing, I suppose, is there's rumours, as there has been for a long time, that capital gains tax rates are going to go up. I think eventually they will go up. My personal view is that hopefully, or possibly not immediately, so perhaps we'll have some time to plan if the changes are announced. But for those people who are perhaps on the cusp of selling a business or what have you, but can't get that done before budget day, then they ought to have a conversation with us about opportunities to accelerate the disposal date for capital gains tax purposes, just to see if that's worthwhile for them. That's the only thing I would say pre-budget.
And the only other thing that I'd add to that is pensions, pension relief. We have a chancellor who famously likes pulling rabbits out of hats, so the papers tell us. Pension relief has been talked about for many years as a target. We've mentioned it for many years that it is a target, and so use it while it's there. I think that message is still the case. Use it while it's there, because it may be that the rabbit that comes out of his hat on the 27th of October is no high rate relief for pension contributions, for instance. We'll see. We've said it before, it hasn't happened. So fingers crossed. But I would always recommend people make pension contributions before a budget if they can, just to make sure they get the relief. I think probably at that point we are somewhat over our time. Now, a number of people have kindly stayed on to listen to answers to questions, but unless perhaps we do one more, Steve, if there's another one. Otherwise, I think we perhaps ought to call it a day.
Well, there are several. One thing we didn't probably mention is when we talked about dividends is distributable reserves. There are a couple of questions sort of alluding to the fact that you need distributable reserves, and we probably failed to mention that.
Yeah, that's a fair point. I mean, in the interest of simplicity, really, we were comparing, dividends with profit share. But yes, fact is you need to consider whether there's sufficient distributable profits to pay a dividend.
Yeah, we were looking at profits, weren't we? And generally speaking, if you've got profit, then you've got distributable reserve. They're types of profit which don't give rise to distributable reserves, but we were trying to keep that fairly simple. But yes, whoever's asked that question is correct. It does need to be distributable in order to make a distribution, normally anyway, for tax purposes. Okay, well, thanks very much, everyone, and especially for carrying on for a little bit longer. We did put a little bit too much in the slides this time. We'll try to get that better next time. We'll hopefully see you in virtual form again in a month's time on the 4th of November for the budget webinar. Look forward to hearing from you then. And obviously, any questions that we haven't answered or any questions that you have that come up later, by all means, drop either James or I an email, and we will see what we can do in terms of answering. Otherwise, thank you very much for listening.